Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and over the past year I've posted many videos on this channel explaining why I was so bullish on REITs. In short, the valuations have been exceptionally low, with REITs often trading at large discounts relative to the value of the properties they own, and this was largely due to the fact that the market overreacted to the surge in interest rates. But as the Fed now brings interest rates back to lower levels, we are seeing REITs rally to higher levels, leading to strong gains to investors who had the courage to buy REITs over the past year. I expect this rally to continue for the foreseeable future because even today REITs remain very reasonably valued, but that doesn't mean that every single REIT is worth buying. This is a vast and versatile sector with over 200 companies in the US alone, and while most of them are very attractive in my opinion, there is a minority of REITs that are over-leveraged or own risky assets, may need to cut their dividend or even dilute shareholders just to survive this crisis. In today's video, we're going to discuss two REITs that we recently sold at High Yield Landlord, which is my REIT newsletter. By the way, if you want to access our full portfolio, you can do so by joining us for a 2-week free trial. It's the first link in the description. But we'll discuss two REITs that we sold recently because we think that they become too risky and ultimately the risk reward isn't particularly attractive anymore. So the first real estate investment trust I'm going to discuss here is called Arbor Realty Trust. This is a very popular mortgage REIT. I often get questions about it on my channel. Note here that I'm not talking about the common equity, and while I wouldn't own the common equity, that's not what we sold because we've never owned a position in it. Rather, we used to own a position in the preferred equity of the company, but we recently decided to sell it. The shares have done really well for us. We've earned strong returns over the years, but there are some aspects about the company that I've become increasingly concerned about, and ultimately I decided to sell my position because I thought that the risk wasn't worth the reward. Just last week I posted a video discussing 3 of my worst REIT investments of all time, and one of them was Medical Properties Trust, and the mistake that I made there is that I was too quick to dismiss the short sellers. Well, the same short sellers who went after Medical Properties Trust and were 100% correct in hindsight, they are also going after Arbor Realty Trust, which I think is today the most heavily shorted mortgage REIT. The short sellers are here alleging that Arbor is using shady tactics to hide some of its growing loan delinquencies. It was recently reported that the FBI is looking into its lending practices. The management of the company, of course, is arguing that they are doing everything by the book and that they are cooperating with the FBI and that everything is going according to plan. But, you know, it's very tough in this type of situation really to know which side to trust. And, you know, one of my lessons from my investment in Medical Properties Trust was to listen to short sellers more carefully, and these guys have a pretty strong track record. They've clearly done a lot of research on the company. I've given good consideration to both sides, and after reading the short reports from these short sellers, I decided that the risk really wasn't worth the reward here, especially in the context of our retirement portfolio in which we owned this position. The goal of the retirement portfolio is to maximize safe income, and I think that Arbor is just too risky for it. We end up earning a 23% return over a 1.5-year time period, and we are very happy with these results and glad to be able to move on to other better investment opportunities. Hey, if you appreciate this type of content discussing REITs that we don't like, I'd really appreciate if you could click the like button. That helps me a lot to keep producing all of this free content for you. Thanks so much in advance. And then the second REIT that we sold quite recently is called Global Medical REIT. This is a small net lease REIT that focuses primarily on single-tenant medical office buildings in secondary markets. It's a higher risk, higher potential reward investment strategy with high initial cap rates, typically of around 8%, and strong rent escalations of about 2%. However, the downside of these properties is that if they become vacant, it can be very difficult and costly to release them. And today this is a growing risk because there are a lot of traditional office buildings that are sitting vacant, and we expect some of them to be converted into medical office buildings, leading to growing competition in the coming years. And unfortunately for Global Medical REIT, they have some of the shortest remaining lease terms in the net lease space at just around 5.5 years. Moreover, they're also already facing some troubles at certain properties. As an example, they are generating 5% of their FFO from Steward, which is the biggest tenant of Medical Properties Trust, which is today in bankruptcy. This is bad news, but I wouldn't be so concerned about it if the REIT had a strong balance sheet and a low payout ratio, but unfortunately this isn't the case here. Global Medical REIT has quite a bit of debt. Its LTV is about 50%, its debt to EBITDA is about 7 times, and its dividend is very badly covered. It's depending on the quarter, it's not even fully covered, so there is very little room for error here. I would add that debt maturity is also relatively short, and as this debt comes due and it refinances, I also expect its interest expense to go up, putting even more pressure on its dividend coverage. Therefore, I fear that the company might have to cut its dividend in the near term, because if it faces just one more tenant difficulty, it will be very hard for it to maintain its dividend, because it's already poorly covered, interest expense is going up, and so just one more vacancy and I think that the dividend will have to be cut. Despite that, the stock is not particularly cheap. It's today trading at 12 times FFO, right around its NAV. I mean, that's not expensive, but it's not particularly cheap either, especially in today's market with many other opportunities trading at much lower valuations. And I think what's holding up its valuation is that the company is paying a near 8% dividend yield, and so yield-starved investors really like Global Medical REIT for this reason. As I mentioned earlier, I think there's high risk of the dividend being cut, and if it gets cut, then I would expect the share price to drop to much lower levels. We managed to earn a 56% return over our 2-year holding period. Again, we are very happy about these results, and we got to reinvest these proceeds in a close peer that's, in our opinion, a lot more attractive from nearly every perspective. It's safer, it's offering monthly income that's comparable, it has much more upside potential, and again, if you want to access our full portfolio, you can join High Yield Landlord for a 2-week free trial. It will be the first link in the description. I really struggle to say the word description. In the description of the video. And finally, if you enjoy this type of content, please click the like button. Again, that helps really a lot to grow this channel. Subscribe as well, because I expect to post a few videos on some of our new top picks later this week. Again, thank you for your support, and see you at my next one. Bye bye.